welcome to Prime Property, your weekly real estate reckoner. I'm Nayantara Rai, and this is what we have on the show today. Finishing touches being given for the launch of real estate investment trusts or REITs. Wanting to insulate REITs from systemic risks such as project delays, the market regulator is in favor of REITs investing only up to 10% in under construction properties and up to 10% in shares and debt of realty companies. The minimum asset value being halved to 500 crore rupees should help in the successful launch of REITs. As REITs will be investing into rent-yielding commercial assets, we thought this is the time to do a check of India's office market. Its prospects are improving given the green shoots in the economy. Chennai suburb Avadhi is emerging as a hub for low-cost housing, with even Anand Mahindra choosing to enter the business from here. Mahindra Lifespace launches homes here for 9 to 17 lakh rupees, and that's cheaper than what local builders have been selling similarly sized houses for at the suburb. The announcement of real estate investment trusts or REITs in the budget has been hailed as a game changer for the cash-starved sector, with experts saying a staggering $7 to $10 billion can be raised over the next 24 months. And within a month of the budget announcement on REITs, the market regulator SEBI is prescribing changes to the draft guidelines it had unveiled last year. This is based on feedback received from financial institutions like Goldman Sachs, Morgan Stanley, Citi and law firms Amarchand and Mangaldas, Luthra and Luthra, besides consultants from PwC and EY. Let's take you through those prescribed changes. First up, reducing the minimum asset size of the REIT from 1,000 crore rupees to 500 crore rupees. Halving the minimum asset size is to make many more assets eligible for REITs.
Clearly, it increases the target audience for REITs because 1,000 crore asset size would mean only the big boys or the larger players would really be able to do this. But bringing the size down to 500 crores means that you have mid-market players who could also participate in this vehicle, who could also set up and sponsor REITs. What it also means that you may not have the best quality buildings coming in.
Since the draft guidelines did not explicitly say so, the final one will. REITs can raise funds from foreign investors, and this is expected to open the FDI floodgates from insurance companies as well as pension and endowment funds.
Foreign investors, pension funds and institutional investors outside India have deep pockets. So foreign investment in REITs will be a very welcome move, and that's really important to give an impetus to a vehicle like REITs. REITs in general also, a lot of the investors in REITs are actually institutional investors and not so much retail, and allowing foreign investment in REITs would be a great move by the government. So yeah, we've been in touch with potential investors who are our clients as well, and they are excited about REITs in India. If foreign investment is allowed, then we should see in the next 12 to 18 months we should easily see something between $7 to $10 billion coming into this vehicle in India.
Industry wanted permission from multiple sponsors while setting up REITs, which at the end of the day is a business trust. A REIT sponsor can be compared to the promoter of a company. The REIT sponsor is the entity or the person that sets up the trust, appoints the investment manager, transfers the properties into the trust, and in consideration gets units of the REIT. In India, joint ventures are very common in the real estate business, and therefore industry felt it's unfair for only one partner to be a sponsor of a REIT. SEBI's agreed to this, but with riders. It will be mandatory for initial sponsor to hold 25% of REIT units for 3 years. The initial sponsor will have to hold 15% of units thereafter. Now, multiple sponsors also means a group of developers can get together to launch a REIT.
It would also allow a few developers or sponsors to get together to set up a REIT. If one sponsor or developer does not have the right size of assets or enough number of assets to arrive at the right size, then 2 or 3 sponsors could get together as multiple sponsors and set up the REIT. On the locking in piece, it would be good if you know all these sponsors are locked in on a pari passu basis versus locking in just one sponsor.
SEBI clearly wants to insulate REITs from systemic shocks and execution delays by developers. That is why the market regulator has rejected the industry's demand of allowing more than 10% investment in under-construction properties. But it is open to REITs trading in new instruments. The market regulator believes greater flexibility may be provided to invest in shares, debt, mortgage-backed securities or realty firms, and to increase the limit for such investments to 20%, including the 10% for under-construction properties. Industry is viewing this as a window for REITs to park excess funds in realty companies.
So I think that's basically for the lead period. So supposing you have the funds to invest, and it takes you 2 or 3 months to deploy those funds and acquire the properties. So that window is basically to keep your liquid cash invested in money market instruments, so that you're still earning some interest on them. So there's really no play out there. It's just a window given to park your funds when you have some excess free funds. So there was a strong industry demand that the condition relating to 90% of the portfolio being invested in completed rent-generating assets is a stiff condition to fulfill. And therefore the threshold of 90% should be brought down to 75%, 70 or 75% more like it. And the balance 25% should be allowed to be invested in a developmental portfolio.
Another industry demand that has been rejected has to do with leverage limits of REITs. Stakeholders say a higher leverage limit improves tax efficiency of a REIT and also improves the returns on the equity component. But SEBI is of the view that it should avoid excessive leverage and the requirement may be kept at 49%. Mandatory credit rating and investor approval above 25% is also necessary. The requirement may be gradually relaxed in the future.
A higher leverage would have, while it would have on one hand meant that a part of the cash is going out for interest payment and debt repayment, it also means that it adds to a higher equity return due to the tax efficiency. And given that any non-resident debt, any foreign debt into a REIT is actually the interest on that is subject to tax at 5%, that would have been a good structure to increase the equity returns.
And the market regulator is still not keen to have too much retail participation at the nascent stage of REITs and has rejected stakeholders' demand of cutting the 2 lakh rupee minimum investment norm. As REITs will be investing into rent-yielding commercial assets, we thought this is the time to do a check of India's office market. The commercial market is all set to bounce back. After hitting rock bottom, its prospects have started improving with the uptick in the economy, new government initiatives and improved sentiment. Manasi Gilani reports the commercial market may achieve a 180-degree turnaround over the next 3 years.
Commercial property market is finally seeing the traction after 3 years. Recent policy decisions and efforts to improve access to finances have excited developers and investors. Sensing opportunities, many investors opened up their purses ahead of the elections. According to Cushman & Wakefield's latest research, net office absorption recorded a 16% increase at 13.4 million square feet across the top 8 cities in the first half of 2014. Compared to a year ago, despite a fall in supplies by almost 7%.
I see at least the commercial market, which was just not moving, will be the area where a lot of movement will happen. And if you see the bond market, which is now allowed in commercial real estate, and the REIT market, which is also opened up, presumably next budget will open up even further, will help a lot of developers to increase their supply on the commercial real estate side, and absorption will happen. People will make sure that their assets are occupied.
The year which has gone by has been tough. Of course, things are looking up slightly better since last 3 to 6 months, and that of course is visible. In terms of increased inquiries, there are increased inquiries. Vacancies are getting filled up faster.
The uptick has been across top metro cities, but Mumbai, according to Collier's research, saw few mid-sized deals conclude in central and western suburbs and Navi Mumbai. Construction activities remain slow in Mumbai, and no phases of projects were complete this quarter. More than 7.5 million square feet of Grade A commercial office space was available for fit-out during the surveyed quarter, of which 80% was concentrated in micro-markets like Andheri East, Lower Perez, BKC and Thane. Rents and capital values for Grade A office space remain stable in all micro-markets. In Bangalore, IT and ITES remain the primary demand driver, contributing approximately 80% in total absorption of 3.8 million square feet. This includes approximately 1.7 million square feet of pre-commitment deals from companies like IBM, Ericsson and Hindustan Coca-Cola Beverages for expansion purposes. Enthused by this demand, a number of developers launched additional towers in their existing projects, including Divya Street Technopolis Block D, Monthly Cornerstone Block B, RMZ Eco World Tower 4A and 4B, etc. And all these projects together will add over 4.8 million square feet of office space to the city's inventory by the end of 2015. Rentals also rose moderately. Delhi witnessed improved demand as office absorption nearly doubled this quarter, amounting to approximately 0.3 million square feet. About 60% of this absorption is contributed by large office space occupiers such as Mozartbeh, Snapdeal and VFS Global. Balanced leases were small office spaces occupied by corporate offices of BFSI, airlines, real estate and media companies. The city added about 0.8 million square feet of new Grade A office supply. Rentals, however, remain unaltered. Collier's outlook for the leasing market across Chennai over the next 9 months is more positive than the previous 2 quarters. The business is expected to rise of the IT-ITES tenants who make up for the bulk of tenants in Chennai. Prime office properties in Chennai are located in 4 principal sub-markets: the CBD, the IT corridor, the SBD and PBD. SBD comprises of Gindi, Manapakam, Velachery and other areas. The PBD primarily includes Amabattur and GST Road, while the IT corridor is the old Mahabalipuram Road, the OMR in South Chennai. Rentals continue to remain low and unchanged. While demand is expected to remain buoyant for the second half of the year, any uptick in the rentals will be largely subdued.
Demand could go up by 10 to 15% for both IT as well as commercial space, especially because IT companies are doing well, US markets are doing well, IT companies are hiring. In terms of rental, I think rentals could remain flat in some of the micro markets, or they could go up by, I would say, 5 to 7% on a yearly basis going forward. But I must caution here that buildings which are, I would say, grade C buildings or markets which are peripheral in nature, markets which are not supported by strong infrastructure could still struggle.
But subdued rentals will not hinder supply coming into the market. In fact, experts expect further unlocking of supplies as large developers look to deleverage themselves using REITs. This would bring in more investors and many HNIs since the minimum investment is pegged at 2 lakhs.
Developers, predominant developers who have been in the commercial space would have at least 30% of their asset portfolio in the commercial real estate, and this would only increase because of the REIT coming in. A lot of developers would focus on, because that's the best way of exiting those assets.
Right now 2 lakhs norm is fine because the product is going to come first time. There's no reason for everybody to kind of jump in, and 2 lakhs is not really very high considering that now investment limit for AIF product is about 1 CR. So while the investment limit for AIF product is 1 CR, 2 lakhs is, I think, just fine. And people with some knowledge, some information should come in.
REITs is expected to channelize nearly $20 billion into the real estate sector in the next 3 years. This could well be a major game changer. An upswing in commercial property demand will only help things fall in place for the real estate sector as a whole. In Mumbai, Manasvi Vilani.
On that note, we're going to slip into a short break. On the other side, we travel to Avadhi, a Chennai suburb. It's fast emerging as a hub for low-cost housing, and it's from here Anand Mahindra has decided to foray into affordable housing. Stay tuned.